Hello, I'm Joanna Seddon, Managing Partner of Presciant, a brand consulting firm dedicated to helping organisations unlock the power of their brands to drive financial value and create a competitive edge. I'd love to share with you some insights into how brands impact enterprise value. The first thing to understand is brand is one of the most valuable assets of any business. Most people do not understand it. It is tragically overlooked and much value left on the table as a result. It's relatively new. It's really happened in the last less than 50 years. It used to be that the major part of the value of a business was derived from physical assets, property, plant and equipment. But with our transition to a technology-driven world, this has completely changed. Today, on average, 90% of enterprise value, as represented by a stock market cap, is derived from intangible assets. A revolution has taken place. In 1975, it was less than 20%. You can see it in this chart from a study by Ocean Tomo. Additional analysis done by Presciant has determined that there are two major intangible assets. The largest is IP, intellectual property, technology, patents. The second is brand or reputation. Brand today is estimated to represent around 1/3 of the value of the S&P. And it's not the same for all brands. Some brands drive a higher proportion of shareholder value and are more valuable as assets than others. This can vary according to the strength or the weakness of the brand, the industry in which it's in, and the audiences which it targets, or even the countries in which it's present in. Brand assets make up a greater proportion of value, not surprisingly, for highly brand-driven businesses, as much as 80% or more of shareholder value for top luxury goods companies, and around 40 to 60% for the best consumer products companies. I can illustrate this by showing you some selected balance sheet information for four very well-known brand-centric companies: Procter & Gamble, Coca-Cola, Kraft Heinz, and Constellation Brands. I'll walk through P&G in detail and then talk more briefly about the other three. P&G's current assets, largely cash and equivalents, accounts receivable and inventory, are $28 billion. Offsetting those current assets are accounts payable and other liabilities to be paid in the very near future of $22 billion. So this nets to what we call working capital of $6 billion. All of P&G's property, plant and equipment totals $21 billion. So for P&G, that's pretty much it for the physical stuff it owns. Yet P&G commands a market cap or stock market value of over $300 billion. So this prompts an obvious question. What are investors paying for? It's clearly not simply cash, inventory, or physical assets. Masby would suggest, and I strongly agree, that the primary value driver by far is the future stream of cash flows generated by P&G's brands. This simple example is the very essence of the financial value of brands. If you look at Coca-Cola, Kraft Heinz and Constellation, you can see that for Coca-Cola, directionally, the story is very much the same. There's a huge premium built into the market cap over the physical stuff that Coca-Cola owns. Kraft Heinz is a little different. It shows similarity in terms of direction, but the magnitude of the brand value premium is much lower. It shouldn't be very surprising, given on public disclosures from Kraft Heinz in which they acknowledge that they're in the process of repairing issues with brand sales performance under a new, much more brand-centric CEO. Constellation Brands may be a company name you're not very familiar with, but they're the producer, marketer and seller of some famous brands, Corona, Modelo and Pacifico Beer. And again, with Constellation, we see a similar relationship across the numbers shown. But it's not just about consumer products companies. Brand represents a large proportion of enterprise value for all companies. The world's most valuable brands include technology companies, such as Apple, Microsoft, Amazon, and Google, financial services businesses, such as Visa, Amex, and PayPal. And it's not just about B2C companies. Brand is an incredibly valuable asset for B2B companies as well. This shouldn't be surprising if you stop to think about it. Brand is reputation, which creates trust. In B2B, purchases are generally bigger. Products and services are often business critical, mission critical. The risks are higher. Trust is vital. Pure B2B companies, such as IBM, Salesforce, Siemens, Cisco, Intel, Saudi Aramco and Accenture, and Goldman Sachs, all derive a large portion of their enterprise value from their brands. The overall winner, however, is a luxury brand. It's Louis Vuitton. Louis Vuitton is a perfect illustration of the dual ability of brand to drive a volume premium, higher sales, and a price premium, higher margins. So brands impact both sales and profits. They can drive one or the other, or in the case of the best brands, both at once. It's a strategic choice for most brands. Prada has chosen the price premium, which more than offsets the lower volume premium that results from the smaller number of people able to afford its products. Walmart has taken the opposite route. It sacrifices price premium for the sake of very high sales volumes. Coca-Cola prices higher than competitor brands and sells more. Louis Vuitton combines both approaches across its product range. The $60,000 trunks, of which it sells a very limited quality, and the $600 or more coated canvas bags, which were introduced to bring in larger volumes from the less fabulously rich. So brand strength manifests itself on the profit and loss, the P&Ls of companies. Enterprises with strong brands consistently achieve pre-tax operating margins in the 20s and even in the 30%. And in the record higher inflation environment in which we've been living 2021 through 2023, these companies also enjoy pricing power that can be used to cover cost increases without an accompanying loss of volume. So brand helps you when times are tough. It helps support the business, support sales and margins. And it's not just about the demand chain. We've been talking about the demand chain and the impact of brand on revenues and margins. Brand also has an impact on the other side of the equation, the supply chain. Studies show that companies with strong brands are able to hire more easily from the top business schools, pay them less, and retain them longer. If you have a strong brand, you can avoid the capital expenditure of entering new categories or markets by licensing your brand to other people, letting them invest and take on the risk, and receive a risk-free stream of royalties in return. Brand can even help reduce the overall cost of capital by making it easier for companies to raise debt and achieving a couple of extra basis points on their bond prices. P&G and Toyota are examples of this. Toyota's even done a study on it. They were so intrigued. So what does this mean for companies? All companies should be looking at the value of their brands and measuring them regularly, just like they do with their other assets. A robust brand valuation, which meets the brand valuation and brand evaluation ISO standards sponsored by MASB, can do a lot more for the company than just quantifying the current value. A robust brand valuation looks at the drivers through which brand creates value. This makes it possible to identify opportunities to leverage brand more effectively by changing brand and marketing strategy and investment to grow the value that brand adds to the business. So brand valuation is so much more than an accounting tool. It's a strategic tool which every company should be using every day to increase the value of its business and create competitive advantage, sustainable competitive advantage. And to close with a somewhat provocative statement, I think if you ask most people who the chief asset steward is at a public company, the most frequent response would be the chief financial officer, the CFO. But based on what you've just seen, could it be that the chief marketing officer is really the chief asset steward at a brand-centric company? If this is even partly true, it calls into question the board compositions of most companies, which tend to have very few marketing experts and be stuffed with finance people, or the pervasive lack of CMO participation in quarterly earnings calls. And this really is why I believe so much in the mission of MASB. It is about elevating the CMO and with them marketing to the role that their rightful role as the drivers of representing the demand chain on boards and as CEOs. So thank you for your attention. And in part 3 of this video series being presented by the Marketing Accountability Standards Board, Neil Bendel from the University of Georgia Terry School of Business will cover where we are today regarding brand value financial disclosures and why this has occurred. Neil will reference recent examples of brand value disclosures and non-disclosures that highlight the dilemmas we face. Goodbye.